In this video, we're going to be performing a deep dive on Abbott Labs dividend safety. To begin, let's talk about Abbott Labs' business model. Abbott Labs is one of the largest medical appliances and equipment manufacturers in the world. Only Johnson & Johnson, which also has other businesses such as pharmaceuticals, has a higher market capitalization. Abbott Labs was founded in 1888 and has grown into a company valued at $120 billion. Abbott Labs is a well-known dividend stock because of its compelling track record of dividend growth. With 46 years of consecutive dividend increases, Abbott Labs is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on Abbott Labs' dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Abbott Labs' dividend safety in the context of the company's current earnings. When Abbott Labs reported third quarter financial results on October 17th, the company announced that it generated adjusted earnings per share of 75 cents in the 3-month reporting period. For context, Abbott Labs currently pays a quarterly dividend of 28 cents per share for a payout ratio of 37% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Abbott Labs generated $2.07 of adjusted earnings per share through the first 9 months of fiscal 2018 and paid 84 cents of common share dividends during the same time period for a dividend payout ratio of 41%. Using earnings, Abbott Labs' dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Abbott Labs' current dividend payments to its free cash flow. Through the first 9 months of fiscal 2018, Abbott Labs generated $4.5 billion of cash from operating activities and spent $927 million on capital expenditures for free cash flow of $3.6 billion. The company distributed $1.5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 42%. Using free cash flow, our conclusion is the same as when we used earnings to measure Abbott Labs' dividend safety, although a second-level analysis was required. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Abbott Labs' current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Abbott Labs' performance during this time period is shown here. Abbott Labs' earnings per share continued their streak of uninterrupted increases during the 2007 to 2009 recession. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic contractions. The last angle that we will use to assess Abbott Labs' current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate would need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Abbott Labs generated $640 million of interest expense and had $23.3 billion of debt outstanding for a weighted average interest rate of 3.7%. The following image shows how changes to Abbott Labs' weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Abbott Labs' weighted average interest rate would need to rise to approximately the 16% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Abbott Labs' current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.